So my next guest, in her August 21st note to clients, it was titled "Rate Cuts in Perspective, a Soft Landing for the Economy Would Mean Takeoff for Stocks." Let's bring in StoneX Chief Market Strategist Kathryn Rooney Vera. KRV, it's been a long time. Let's begin with the premise are you more confident than of a soft landing now this morning after listening to Powell?
Well, after listening to Powell, it doesn't make me more confident in a soft landing. I think the risk is elevated that we could go into an economic downturn. I think that's really underpriced by the markets. It's not my base case, but the risk is elevated, and I think it's worth protecting your portfolio against that potential risk.
All right, we're going to talk about protection in a moment, but in that report, you highlight how badly markets react when we have these rate cuts, and they occur at the same time that there's a recession. You go through the past seven cycles. Three of them, of course, has happened. What I was shocked at were the froth, right? The declines as much as 49%, 57%, 37%. I think the problem, though, is that the National Bureau of Economic Research timestamps recessions long after they happen. So how do we know if we're in an environment where that's happening?
We don't know until after the fact. So yes, the economic data could be downwardly revised in a big way to indicate that we are in fact in a recession at the moment. We don't know that. That's why now is the time, when the markets have recouped all of the meltdown that we saw a few weeks ago. Now is the time to protect positions against that possibility. And Charles, you're right. What I did was I looked at past monetary policy cycles, because really you see the recession occur potentially after the first Fed cut, not when the Fed's hiking. So over those 7 episodes, 43% of the time after the Fed starts cutting, in the next 12 months, the economy goes into recession. So the next logical question is, what happens to the markets? And the answer to that question is, if the economy after the first Fed cut does not go into recession, the S&P on average increases 10%. If it goes into recession, then you get a negative 19-20% downdraft in the S&P 500.
And so looking at your work, then it feels like, hey, rotate out of big tech. And it looks like a lot more defensive. We got your strategy team, the U.S.-centric calls, utilities, consumer staples, healthcare, and industrials. That's where you feel comfortable right now.
Yes, and I also feel comfortable telling guys and gals, look, the soft landing could very well occur, but protect those tech positions. So it doesn't mean liquidate them, but you can, where the VIX is right now, which is the risk, the fear index, it's dropped again. So you can buy very cheap put options on the NASDAQ, on tech sector. So you can buy that, you can buy gold. You can start to accumulate defensive sectors such as utilities, which outperform in down cycles, economic down cycles, but also do well if the AI trade continues this momentous rise higher, because we all know that ChatGPT requires a lot of energy, and tech requires also industrial real estate. So I think those are good places to be at the moment.
And the utilities have this really a stealth. They've been a rocket ship that no one's talked about here. No one's really seeing it, but they have come on strong. Less than a minute to go. I do want to lean on your expertise, right? You're an international firm. You guys have a big international footprint. So you're abreast of geopolitics. You know, we see from time to time that comes high on Wall Street's radar. What is the state of the world? What is the potential of something impacting our financial markets?
Well, in terms of the global economy, what we're seeing is a disinflationary trend, and I think we're in a pretty good position right now. The question is, where does the United States go? And if we get a rollover in the labor market, then we could see a contraction in consumption, which I'll remind everyone is 2/3 of the U.S. economy. So as goes the U.S. consumer, so too goes the U.S. economy, and that would have repercussions around the world. So for now, I think a soft landing is probably the base case scenario, but the risks are elevated over the course of the next 12 months, and I think those risks are sufficiently big enough and sufficiently underpriced to protect against them in your portfolio.
Right, and these increased, the situation in Israel, the Middle East, in Russia, Ukraine. That is, how much is that worrying you right now?
Well, those are black swans that are impossible to predict. We can say that the tensions are escalating, and any one of those things would cause a big risk-off move in the markets, to which the Fed has the capacity to slash rates. So were there to be a conflagration in the Middle East, potential jump in oil prices, the Fed would slash rates, and they have the ability to do so.
Kathryn Rooney Vera, KRV, thank you very much.
Thanks, Charles.